What you're about to learn is a way to buy a house with bad credit, with good credit, and most importantly, how to get your credit score up. I'm also going to share with you the mistakes that most people make when it comes to buying a home. Listen, the mistakes are what cost you a lot of time, a lot of stress, and a lot of money. You want to avoid doing those. I'm also going to share with you the good and the bad of each of these types of loans so you can make the best educated decision. So listen, grab a pen, settle in. You're going to want to take notes. Now let's begin with how to buy a house with bad credit. To buy a house with bad credit, I tell people there's no credit check, no job history check. All you have to do is write a check. So you have to have a little bit of cash, but here's the way it works. An owner owns a property and they can own or finance it. You don't need a bank, a mortgage company, you don't need anything. They're basically carrying the note for you. So they're acting as the mortgage company. You simply give them a down payment, which is typically around 10% of the purchase price of the house. So you got to know if it's a $200,000 home, it's going to cost you 20 grand. A $300,000 home is going to cost you $30,000. Now, a question you need to ask is, what are the closing costs? Great question. The closing costs typically run you whatever it costs to have a title insurance policy, and that's going to vary based on the percentage of the actual loan. For example, a $200,000 home is going to run you anywhere from $1,200 to $1,600, but you never want to buy a house without a title policy. Keep taking notes. It's going to get better. You also want to know that there's an interest rate set. That's negotiable. That rate is probably going to be anywhere from 1.5% to 1% over the current rate. So if the rates are 7%, they may be charging you 8%. But you just have to always remember this. If you can live with the payment and you can live with the house, it's not so much the cost of the money, it's the availability of the money. This is the way you can purchase a house, remember, with horrible credit, no job history check, and no credit check. But listen, there's more to it than that, and it's a good thing for you because you're paying an interest rate, but you're also paying down your principal balance. You see, you're putting down a down payment when you purchase an owner finance type property. And that down payment, if it's 10% of a $200,000 home, that's $20,000. You now have a balance of $180,000. That $20,000 is yours. It's just in the home. That's called equity. You have equity in that property, which is a good thing when you go to refinance that property into the future, because now the home's going to go up in value. You are paying interest on that like you would a traditional mortgage, but you have to also understand you're paying down the principal balance. And as you pay down the principal balance and you go get traditional financing, let's say the person that's selling you the property say, listen, I'll sell you the property, but in 3 years, I need you to get traditional financing. Now, I don't need you to be worried about that, and here's the reason why. You just bought a home, you had to get your driver's license in your name, the electricity bill's in your name, you've been paying all those on time, plus you have a home where your name's on the deed and the title. So then you're going to go to a lender in 2 to 3 years into the future. You're going to show them, I'm still working, here's my credit, it's improved because you've been working on that. I also own this home, I'm just looking to refinance. At that point, you're a golden child for the lender. They want to loan you money. You have to understand, people do the banks a favor by allowing the banks to loan them money, not the other way around. Now, if you've got good credit but not bad credit, a way to get a loan is through a mortgage company, and you can get an FHA loan. That stands for Federal Housing Administration. These are loans backed by the government, and they are less risk for a lender. Being that they're less risk for the lender, your credit score doesn't have to be quite as high, and it's a little bit more lenient if you're, say, self-employed. Now, the bad about an FHA is that you have to pay private mortgage insurance, and you have to pay that every single month like clock regardless. The only way to get it off is if you refinance to a conventional loan. And look, you don't want to refinance to a conventional loan until you know with confidence that you have 20% equity in the property. Remember, I was telling you about the equity. So you're putting money down, you're paying down the balance, 2 or 3 years, 5 years goes by, and it's going up in value. So it's going up, balance is going down. Do you have 20% equity? Once you feel like you have 20% equity, you can call a real estate agent and pay them to do a comparative market analysis to kind of give you an idea, or you can have an appraisal done. I always suggest people, before you even have the appraisal done, make sure that you feel with confidence that it's there, because it's going to cost you $400, and you want to make sure you don't spend $400 prematurely. You want to make sure that you spend the money, it's going to refinance to a conventional loan. It will cost you to refinance, but you can roll that into the actual loan balance, if you will, if that's the case. And that way you get the private mortgage insurance completely taken off. Now, if you've got great credit, you may want to skip the other two and go straight to a conventional loan. The pros about a conventional loan is you don't have to pay in PMI. The downfall is you got to have better credit score, 690 or higher thereabouts. You also have to have more money out of pocket. It's going to cost you 5%. Now, even though it's going to cost you 5% down on a conventional loan, you just have to know that if you put 5% down, you're still going to have to pay PMI. However, once you get 20% equity in the property, you can call the mortgage company. You don't have to refinance. You can call the mortgage company, have the property appraised, cost you $400 to appraise it, and they will remove the private mortgage insurance for you. Now, if you or someone you know is a veteran, you need to look at a Veterans Administration loan for a couple of reasons. One, there's no private mortgage insurance on a VA loan. The federal government insures the loan. The second thing that's really cool is they will loan you up to 100%. The seller can pay all of your closing costs. And the third thing is, if you wanted to purchase a $1.5 million home, as long as the lender will lend you the money, the federal government doesn't have a ceiling on what they will insure on a VA loan. Now, another loan to consider, however, you are limited on your income, so you can't make over $110,000 in most areas, but a USDA loan, United States Department of Agriculture, is backed by the federal government. Falls into the same FHA guidelines as I'd mentioned. You have to have a 620 or higher credit score and be on your job for 2 years, and you can look into purchasing these loans. Now, these loans, USDA, means you have to be on the outskirts, 30 to 40 miles typically outside of major city limits. The downfall of this, as I'd mentioned, they fall under the same FHA guidelines, so you will have to pay private mortgage insurance until you refinance that property. Now, another loan to consider is what they call private money lenders or hard money lenders, and I never recommend them for long term. Those are typically short term, like 6 months to a year and a half at the most, and that's when you can purchase a property like a foreclosure, for example. They'll loan you typically 80 to 90% of the value of that property. You can put some sweat equity into it, improve the value. Once you improve the value and get your credit score up, if you're 620 or higher, then you bought the home, you borrowed money from like a hard money lender. They're typically going to charge you 10, 12%. And in doing so, you do have access to the money. You can purchase a property. These are great loans if you're like in construction, you're really good, you're really handy, you're a contractor, subcontractor, you can purchase houses this way and it not cost you a whole lot of money out of pocket. They may want you to have 5% down. They'll loan you the rest. It's temporarily, and you always have to know that. It's not the cost of the money, it's availability of the money, because once you make improvements to that property, they're going to reappraise it now that you've made those improvements, and they will loan you, for example, on an FHA loan. So you can have the property reappraised and you can pay that hard money private mortgage lender off and start all over with a brand new FHA or conventional loan. Now, the biggest mistakes that people make is quite simply this. They go to get approved for a loan and they're constantly putting stuff on credit. You need to make sure you stop using your credit cards. Just try to stop putting stuff on credit. You also want to make sure your balance to your credit cards are 30% less than what is your allowable credit limit. So if you've got a $1,000 credit limit, you need to try to get the balance at 300 or below. That's another thing that can boost your score. You also, and this is like the kiss of death, once you find a property and you've got good credit and you're 620 or higher, right? You never want to start putting stuff on credit. Don't go finance a car, don't go buy a computer, don't go buy nothing. Don't go apply for a new credit. Don't put anything on credit. I can't tell you how many times before I just started shouting to the rooftops because people would go buy a computer or couches and furniture because they're excited. They just bought the house. You just have to know this. A lender will pull your credit to approve you. They will also pull your credit within 24 to 48 hours of you closing on your home. And the last thing you want to have is them to tell you you're denied because your credit score is now lower than it was when you wrote the contract on the house. So look, if you've got bad credit, you can get your credit score up by simply paying down credit, paying off credit cards, selling stuff, keeping your balances 30% below. If you have bad credit, you can purchase a house owner financing. There's no credit check, background check. You just write a check. Remember, it's only 10 to 15 to 20%. Everything's negotiable. Somebody may say 20%. Ask them if they'll take 15% down on those owner financed homes. If it's an FHA, it's going to cost you 3.5% down. The seller can pay all of your closing costs, so you're looking at 3.5% down payment. You got to have 2 years on the job and a 620 or higher credit score. The same's going to go for the USDA. If you're conventional, you're going to need 5% down, and with 5% down, the seller can pay all of your closing costs. However, you're going to have to pay private mortgage insurance on all of these unless you put 20% down. And VA is quite simply a Veterans Administration loan. It's insured by the federal government. You can get up to 100% of the loan. There's no private mortgage insurance, and there's really no ceiling on what they will insure. And if you're a contractor and you want a hard money loan, you can do that. Like I said, it's not so much the cost of the money, it's the availability of the money, because it opens up a door of opportunity for you to make money. I'm Wayne Turner. Thank you for watching. Subscribe to the channel, leave a comment, leave a question. Until next time, God bless.